All right, everybody. This is Ian Smith with Rate. I appreciate you tuning in. For those of you that joined me for the live session of this call, I really appreciate it. I know there were several of you. For those that didn't, guess what? I forgot to hit record. So I am recording this for you guys so that you have this content and can use it and help more clients get into homes. Today's topic is renovation loans. I'm super excited to be talking about renovation loans. It's a very underutilized product for mortgages. It's very little talked about. Like, people just don't talk about it a lot. And so today we're going to do a lot of that. We are going to talk about renovation loans. Now, since this is not the live session, there's not going to be as much dialogue and back and forth with others. But I will do my best to narrate and cover as much of the topics that we discussed yesterday as possible. So what is a renovation loan? A renovation loan is essentially the conversion of what used to be two loans into one. And why are we talking about renovation loans? Well, I've noticed that as this market has shifted a little bit, listings that are not perfect or listings that need work are tending to sit on market for a relatively long time. Some of these may even be cash-only listings because of some sort of issue that came up in appraisal, and the seller's not willing to make repairs. Typical financing may not allow for a buyer to get into this home. And so what you have is, potentially the issue where only investors are left as the pool of buyers. Now, if you're only working on a listing that can tailor towards investors, you are removing a significant portion of the buyer pool. So the whole idea of a renovation loan, in this particular sense, is to help these types of homes find a new owner who is willing to do a little bit of work with the help of these loans to put them in a better position. The homes in better position, but them in a better position with having a renovated house. So what do we do on a renovation loan? We finance the purchase and the repairs in one loan. So, going back to, merging what used to be two loans into one, this is huge because, previous times, buyers would go get the typical mortgage, and then they would go to a bank and say, hey, I need a personal loan, and they have a personal loan to finance the repairs. But that personal loan may have terms that are 3 years, 5 years, 10 years, whatever. So that monthly payment on those repairs will be higher. In this particular case, we're financing it into 30 years. So 30 years definitely reduces the overall cost to the client and essentially helps them get, a lot of work done to the property that they otherwise either wouldn't be able to afford or would just have high payments and have to stick with it. There's a couple different types of products that we're going to talk about today. The first is your FHA loan. This is your 203K product. The second is the Fannie Mae product. This is your HomeStyle. 203K is a very common renovation loan amongst a lot of lenders. And the many lenders I've worked with, several of these have had the option to do the 203K. A lot less have had the option to do the HomeStyle. I'm pleased to say that my current company, Rate, offers both of these programs, and I'm super excited to help you all have clients utilize these programs to get into homes and get a lot of work accomplished. Now, the 203K has a 3.5% down payment, 580 credit score. There can be, some wiggle room to do a manual underwrite and down to 500 with 10% down, but typical clientele is going to be 500 or more. This is primary residence only, okay? Now there is a renovation cap of $75,000. This is for a limited 203K. A non-limited has no cap on the renovation. However, it does have a cap on the loan amount as typical with an FHA home loan. Mortgage insurance is for the life of the loan. So what that means is that for as long as the clients have these loans, they're going to have mortgage insurance. Which differs from your Fannie Mae option, which has the mortgage insurance, as typical with conventional loans, fall off once they've achieved that 20% threshold of equity. Now, the HomeStyle product has as low as 3% down, 620 minimum. Occupancy can be primary, second, or rental. Now, these are going to fall under the same down payment guidelines as they do for a traditional loan product. So primary, 3% for first-time home buyers, 10% for second loan or homes, and 15% for rental. Now, the renovation cap is 75% of the as completed value of the home. So that is determined by the basically after repair value of what the house would look like. So that would be our cap on the renovation. And then, why do we look at the 203K in two different ways? So the 203K loan product for the limited again has 75,000 in capped repairs. No structural work is allowed. The home has to stay livable. You do not need a HUD consultant, which we'll talk about a little bit later what that is. And the project must finish in 9 months. Now, this is ideal for small renovations like a little kitchen upgrade, a little bath upgrade, maybe replacing the roof, HVAC, flooring, paint, windows, etc. I think we can all agree that windows have gotten very expensive, and so this is now becoming one of those things that is very commonly used for. Someone's like, "Oh, I want to replace the windows in the roof." Great, this is a great product for that. Get it financed over 30 years. Don't do the predatory lending that the roofers, are going to offer. The window companies like Pella would do, and save yourself a lot of money on a monthly basis. The standard 203K, this is much more flexible, so you can do structural work like add additional walls, additions to the property, foundation work. It does require a HUD consultant, which again we'll talk about, and you have to finish it within 12 months. You can do gut rehabs, layout changes, and literally you can move the home onto a lot. Now I say that with the preface that very uncommon, but it is possible, and it is part of the product. A HUD consultant is an independent, approved individual who is either an architect, engineer, contractor, all licensed. Their job is to write the scope of work and the cost estimate, so that we can have an independent third party, kind of verify that whatever the contractor is actually going to be charging the client during the work process, that this is kind of in line with what should be expected. The whole idea of a HUD consultant is to prevent, various skimming, fraud, etc., abuse from contractors. They're just supposed to be neutral. So they're a benefit to the client. It's not a detriment. They do cost money, of course, but it helps protect them from the nefarious situations. Again, I want to emphasize that the 203K has some interesting, features like being able to move a home onto a lot. It's very rare that you're going to see this. I've never seen it in my 11 years in this business, but I figured since it was something that was possible, we could talk about it today. So where does the 203K win and where does it bite? Okay. So first, it has a very low down payment, even for non-first time home buyers. 3.5% is awesome. You can go down to a low credit score. It's one loan, one closing, one monthly payment, all bundled into the one transaction. And then repairs can finance tomorrow's value, not today's cash. So we'll go over some examples of why that's beneficial. But the limitations are that it is only for primaries. So you can't do it for a rental or a flip. You've got mortgage insurance for the life of the loan. The contractors must be willing to work with some additional FHA guidelines. And then they just take a little bit more time to close. So 45, 60 days is pretty normal for this loan option. So, when you're going over this, when I'm going over this with a client, when we get to the nitty gritty of the nuances of doing a renovation loan, it can kind of get a little overwhelming, right? There's you approving a client, and then there's approving a contractor, there's approving the scope of work, and everything has to kind of come together to get to the closing table, and it can sound a little scary. But what's not scary is the benefits, right? So let's say the property that the client wants to buy is $280,000. They do $50,000 in finance renovations. Their total acquisition cost at this point is now $330,000, and their appraisal for the completed value of the home after renovations is $355,000, and they put $11,550 in down payment. Guess what? They have $25,000 in day one equity because they've improved the home. They've done something to improve this house, right? So whatever repairs, whatever work that they did, the home now likely is going to have a higher equity position than their down payment because they've done improvements. So for clients, This not only can make the move into the house more comfortable because they're moving to a nicer home now than what it was when they, first saw it. Financially speaking, it's a good move as well. Now, the conventional option, this is going to be a little bit different and have more flexibility. So 3% for first-time home buyers, really cool. You can do rentals in second home. You can do structural work. There's no limited versus standard, so it's all just the same loan. We don't have to think about all that stuff. We don't have HUD consultants either. And then again, the insurance, the mortgage insurance, it falls off. So when we go through our example, we'll talk about that a little bit more. But again, a benefit of the conventional program. So where does it win? Where does it bite? So rentals, second homes, primaries, again, for the third time, it's a big advantage. You have flexibility as an owner, investor, whatever you may be, to take advantage of this program. No cap on the structural work within the value limits. Mortgage insurance, as we said, and often prices a little bit more preferred than 2 or 3K. I will say that with a caveat that it really depends on the timing and the market. So sometimes the market prefers the FHA product, sometimes it prefers the conventional. It really just depends on the timing. But more often than not, the conventional is a little bit better priced. Their limitations are you need a higher credit score. Repairs are capped at 75% of the as completed value. You do need a bigger down payment on rentals and second homes, but you would need this anyways for those types of occupancy. And to be honest, fewer lenders offer this product. As I said, 2 or 3K is relatively common. Conventional is not. In the several companies that I've worked for in my 11 years of career, this is only one of 2 companies that have offered this product. So it's pretty rare to come across for whatever reason, but we do offer it. And it's something that we're excited about. Now let's talk about the conventional scenario. So I'm going to talk about the exact same thing we went over 2 or 3K, add a little bit of caveat. So let's say the list price on this home is $425,000. The buyer finances 85,000 in renovations, bringing their total acquisition cost to $510,000. Well, they get an as completed value or after repair value of the appraisal back at $560,000. They only put $25,500 into the transaction, and guess what? That day one equity based on that appraised value is $50,000, guys. $50,000. So for clients, who are willing to take this on and do a little bit more work before they, fully move into a property. Not only can it make the property nicer for them to live, but this gives them a lot of equity. So, when I'm talking to clients in initial consultations, usually for couples, you have one person that's big on numbers and one person that's big on aesthetic, right? And so, with these types of programs, you can check both boxes because sometimes you get a client or a couple client that, they can't agree on what's more important, the numbers or the aesthetics. And sometimes you just can't get both because of budget or location or whatever the case may be, right? But this program solves a lot of that challenge, right? So I'm super excited to kind of present this to you all because it's a very underutilized product and so many clients are leaving, opportunity on the table by not doing this. This example right here just shows why it's important to look at options that are out there. It's not just your normal loans that clients have at their disposal. This is something that everyone can take advantage of. So which loan do you choose for which buyer? Well, 2 or 3K when the buyer's credit is thinner, cash is tight, and it's a primary home. If they do the limited, it'd just be cosmetic work. They'll do the standard if it needs more like structural stuff. They'll do HomeStyle if the buyer has a little bit better credit profile, or it's a rental or a second home. And of course, the cash flow part of the mortgage insurance, which guys, I completely forgot to talk about. So going back to this example, right? So day one equity, $50,000. They're already halfway to their 20% equity day one, right? So, their mortgage insurance is going to fall off significantly quicker with the work that they've done to the property as compared to someone that just buys an as-is home and does maybe some paint or light touch-up. They're going to get their mortgage insurance removed. So let's just say they have a $100 mortgage insurance payment. Well, guess what? They're going to knock that off way quicker, by taking advantage of the HomeStyle product. So, again, another benefit of it. But to be honest, both products work for primary buyers. So it just kind of comes down to their individual profiles, what we end up pushing, as far as the better option based on pricing, what their needs are, etc. So where does renovation loans fall apart? I think this is the big ticket question. Like, what's the catch, Ian? It sounds too good to be true. Well, the contractors have to play ball, right? So there's a couple of things as part of contractors. When we're doing, a renovation loan, we have to approve a contractor to make sure, they meet certain criteria. It's different for FHA and conventional. And they also have to be willing to handle the process of draws. So where a lot of contractors don't like these products, it's because of the restrictions on how the draws are done. So a lot don't want to wait on the draws and don't want to flip the cost before the draws. So some will not want to do these types of loans. It's pretty standard when you're doing, fix and flip loans or ground up construction, etc., to have draw periods. So, it's one of those things where most contractors kind of understand, but some just don't want to do it. And that's something that, clients will have to kind of shop around various contractors to kind of see who is willing to kind of go down this path. Timeline slip, guys. So bids and consultants, or consultant on bigger jobs and draw process stretch closings. If we have to redo, some part of the numbers because of the after repair work, maybe doesn't exactly yield the results that we need for the loan to work or something like that. We have to kind of continue updating the bids, talk to the consultants on the FHA 203K, and again, it can cause some delays in that initial closing. So timelines can be something that's really important and something that can cause these loans to fall apart, especially if you have sellers that are getting antsy. Change orders, so part of these loans is some people come back with later requests. They had an idea, so then they want to pop in, and change orders may be something that they want to throw into the equation. We have to accommodate that. That can cause either delays or that can also blow up the appraisal, right? Because the appraisal may not be able to yield back the value. There may be a change that the client wants to add that doesn't really give a lot of value to the home, and it can cause, some sort of issue or at the very least additional paperwork. So, scope creep is a thing. And then, this kind of yields into the values, doesn't support what they're looking for. So, it's possible someone just wants to only do cosmetic work, and cosmetic can yield some value, but there's only so much it's going to yield, right? And it may just not work. And that's the whole purpose of the due diligence period, is to kind of work through this with the appraiser, the HUD consultants on the FHA, and kind of make sure we're going to get the value that we're looking for. And your job as an agent is to help us as well kind of figure out, once this is all done, what are the comps? Like, what comps are we going to be able to get so that we can plan early and often to help the clients have a highest chance of success. Now, going back to the draws. So one change that happened this year, so this is like fresh off the decks, new as of 2026 June, is that the draws have increased from 2 to 4 for the limited 203Ks. So this was a big deal because, again, contractors were having to float a significant amount of costs that they weren't happy about. And so a lot of them were just like, I don't really want to do this. And so you had a lot of contractors just say no to jobs. Well, this increase doubles the amount of draws, reduces the amount of float that these contractors have to carry, and makes it a little bit more fair to all sides. So great update. Super happy to see it. And, contractors as well are going to essentially be more willing moving forward to take on these FHA limited jobs for sure. Now, what does the map of one of these products look like? Okay, so the very first step is to pre-approve a buyer. Guys, we're going to do exact same pre-approval as we've always done. We're going to work up a max. We're going to look at comfortable monthly budget. And once we kind of have that in mind with your client, we're going to let them know what that number looks like. And so if they are specifically targeting a renovation loan, we know, okay, we got to get the property in much lower than whatever their number is to accommodate the various renovations. Now, it may not have to be much lower. It may not need to only be 20, 30K lower, but at the very least, we know our numbers of what we're working to so that you and your clients can figure out where does the house and budget for repairs need to be price point wise to get to the number that they're satisfied with and approved for. So that's part of also number 2 is just finding the right home that fits that whole scenario. Once they're under contract, we're going to want to work with getting scope and bids. So, as part of the FHA 203K, we got to work with a HUD consultant. On the conventional, we just got to get the bids and such from the contractors so that we know what the scope of work is going to be. And then we're going to order an appraisal based on all of that. So the appraiser can go out there and based on the scope of work, figure out the as completed value or after repair value of the home. Assuming all those numbers check and everything looks good, the contractors that are going to do the job after closing are approved, we'll approve the loan, we'll close the escrow, and then that starts the draw process and the construction process of the home. And then eventually, that will be complete and the clients will have a lovely, beautiful, renovated house. So why is this also important for listings? I mentioned this in the beginning of the call, but guys, there's a lot of listings out there, again, that sit. And they're not always marketed very well. I've seen it time and time again on the MLS that, because a house has issues, it's marked as conventional. I'm sorry, not even conventional. It's marked as cash only, right? There is this renovation product. And if you're marketing it as cash only as a listing, you're removing the potential for buyers who are willing to do work from being able to make an offer on this home because their agent saw that it's cash only. They know their client isn't cash buyer, and so they just move on to the next, right? But if you remark the listing as renovation loan eligible, conventional renovation loan eligible, or something that indicates that financing is an option, you're going to open up your buyer pool significantly. Now, the expectations that you need to have for your sellers is if you do get a non-cash buyer, the closing is not going to be super, super fast. Cash buyer can close in 7, 10 days, whatever. If we're doing a renovation loan, this is 30 to 60 days depending on the program. So, it depends on what your seller's goals are, but if they're trying to look for highest and best, having more of a pool of potential buyers is going to give that to them. They just have to be understanding of what the expectation is on the closing timeline, as well as, what realistically price point wise that they're really going to get. But my goal is to help you. So, as always, even if it's not a buyer, potentially, even if it's just your listing, I want to help you market the home. Ideally, whoever's going to buy that home may see that my information is being shared as someone that can help them with the renovation, and I love that. But we can do custom marketing for your listing to help educate the buyer pool out there and what the potential is. We can even pre-run numbers. So let's say you have a contractor that you can share pictures of the property with and just say, oh, what if we, pimped out the kitchen or, something that brought additional value but also made the home more comfortable. We can run those numbers and we can create a little mock scenario. And you can advertise that as part of open houses and your listing, etc. So, our goal is to help you as an agent, be able to move your property, but help buyers get the properties that they want. And we've all seen it. We've got a lot of millennials and Gen Zers who have lived in quote unquote luxury apartments for a long time. And they get a little bit of culture shock when they go from that to buying a resale property. They want to own a home and they want to, eventually work on it, but they get a little scared because it's just not what they're used to. They're used to the cheap but nice looking luxury apartments, and that's what they want. They want something that feels nice, but they also want a home. So let's help them do both. Let's share the information about the renovation loan. And if you have anything or any questions or any buyers that are curious about this kind of stuff, definitely feel free to share my information. As always, you can access all my contact details through my link tree. And I will be more than happy to assist you, your clients, and all things in the future. But I appreciate everybody tuning in. It means a lot that you do this every week. Next week, I have yet to set my theme for next Tuesday's call, but again, Tuesday at 12, every Tuesday. Very few exceptions to that rule. Look forward to seeing you all then, and I hope you have a great rest of your day.